Well, it's happened sooner than expected. UOB didn't want to miss out on the rate cutting party, so it has cut its own interest rates on the UOB One account, following in the footsteps of OCBC. But what does it actually mean for investors? Why are banks actually cutting interest rates? I'm going to break it down for you. There's a lot out there about the specifics of what rates have been cut to, so I'm not going to bore you with the details, but basically it's come from 4% on the first 150K down to 3.3% for the first 150K. So you're getting 70 basis points less. Why is that the case? Well, it's all tied to the US Federal Reserve and their interest rate policy. It's boring AF, I know, but this actually relates to where the Fed thinks interest rates will end at the end of this year. This latest March meeting, the US Fed actually believed that by the end of 2025, there'd be a further 25 basis point cuts to the interest rate in the US. Since then, shit has hit the fan, and that's down to one man, Trump, and his across-the-board tariffs on all countries in the world. So what's the result of that? Well, basically, the stock market is expecting more interest rate cuts this year than the Fed projected even last month, with some analysts thinking there could be 3 to 4 interest rate cuts by the end of this year. What does this mean in the context of Singapore banks? Well, basically, they're front-loading their cuts now to depositors so that they can earn that extra spread for a few months longer. In short, expect more cuts to the OCBC 360 and the UOB One account in the months ahead, as the market is now expecting the Fed to start cutting interest rates as early as June. For more personal finance and investing tips, as well as money insights, do give me a follow here or subscribe to my free weekly newsletter at timtalksmoney.com.